Hi everyone, welcome to the USUDC 2025 training for the open quarterfinal. The motion reads, "This House regrets the recent rise of private credit." We'll be doing a PM-LO exchange on the motion, and then after that we'll talk about our reasoning for placement, strategic notes on the motion, and possible extensions that you could run after the cases that XK and I run in this demo. Three things on setup. One, just to be clear, before the significant rise of private credit, most small and medium enterprises sought syndicated loans from traditional banks. The way these loans work is that one lead bank would offer an SME a loan, but many other financial institutions would cover portions of that loan. To obtain that loan, the SME usually needs to meet banks' regulatory requirements and needs to get approval from banks' credit committees before receiving that loan. And on top of that, usually SMEs seek out different types of loans from banks, and in some cases, these loans are sold off to other investors. To be clear on the differences between this and private credit, number one, in the case of private credit, usually non-bank financial institutions set up their own private credit firms, which give SMEs one massive loan that they use to start up. The loans are given out relatively more quickly. More on this in my case. Just to be clear on the rise, it is hotly debated what caused this rise, but one of the biggest likely reasons this rise happened is because banks' regulatory standards have meant there was still a good amount of unmet demand for loans. We are happy to take the trade-off between risk and growth, but to be sure, we are only regretting the recent rapid rise that began in 2020. Private credit is still a multi-billion-dollar industry on our side of the house. One argument about how the rise of private credit increases financial instability. Three tiers in this argument. Tier number one is that private credit makes financial regulation far more difficult. The underlying reason for this is that information about companies' indebtedness is not publicly available. And the reason for this is that loans given to companies are private, which means that private credit firms are not required to disclose information about them. Why is that harmful? Because financial regulators now have far less information about which sectors need the most help. So for instance, if a bunch of industrial companies are distressed and are operating on loans from private credit firms, no one knows that now. The government can't step in to provide fiscal support to these businesses. Regulators aren't able to do things like implement leveraged lending rules. See, for example, what the government in the US did in 2013 after the great financial crisis. So to be sure, even if financial instability would hit a particular market anyway, the difference is that private credit means you can't intervene preemptively to soften the blow. The comparative is when banks give out syndicated loans, information about them is available on data loan market providers, allowing regulators to intervene when they wouldn't be able to otherwise. Secondly, private credit firms also increase financial risk, and there are two underlying reasons why this is true. One, remember that a key feature of private credit is that it allows SMEs to access loans extremely quickly, usually within a few days. And this is a massive problem because companies take a very long time to grow, particularly the small and medium enterprises that these private credit loans often get given out to. So even if private credit analysts have past information about a specific company, they're not taking that much time to do due diligence about the fundamentals of the company, especially with the rapid rise where many different private credit firms are all trying to get in on the market, meaning invariably the set of companies that get these private credit loans are ones that are likely to have weaker fundamentals versus having a better selection effect on our side of the house. But secondly, private credit firms compete against one another increasingly. What this means is that there is likely to be a long-term decrease in the lending standards of private credit firms, even if lending standards are somewhat diligent right now. And to be clear about how strong this competition is likely to be, private credit grew by over $1 trillion in the past 4 years and is slated to reach $3.5 trillion in size by 2028. And remember, because any new asset class always starts off with low default rates, investors think that it's okay to do this. And then, whoops, you create significant amounts of financial risk later down the line. Decreasing lending standards is bad because it means that you give these loans to many more new companies, which may not have this proper growth potential and may not be able to properly repay your loans. The comparative is the following. One, of course, banks have stricter regulatory standards. Our claim is that this is good because banks are subject to regulatory oversight, for instance, Dodd-Frank regulations, which means that they don't frivolously give out loans to companies that may not be able to repay those loans in the first place. But secondly, on our side of the house, private credit is still a multi-billion dollar market. It's just not a trillion-dollar market. There's less competition among private credit firms, meaning there's competitive pressure to decrease lending. The competitive pressure I mentioned doesn't exist to the same extent. That means that The private credit loans that we're giving out on our side of the house are probably less allocated because private credit firms can afford to be a bit more discerning and give these loans only to companies which do have good fundamentals. Mechanism three. When companies take out private credit loans, it's usually with one or a few big loans from the same private credit firm, and management is pretty personalized. Whereas when banks give out syndicated loans, that also means banks usually chop up these loans and give them to a bunch of different investors, such as hedge funds. That means that companies which take out syndicated loans have a harder time renegotiating terms on their debt. Our claim is that this is good because that on their side of the house, when companies can tell themselves, we can easily renegotiate the terms of the one big loan that we have taken out. There's no moral hazard. You can make riskier financial decisions and then just go back to the private credit firm and say, can we push interest payments down the line? Why will such companies still make these risky financial decisions? Because in many cases, you're giving these loans to small and medium enterprises where they're in a survival mindset. They want to focus on immediate gains, where they think that they need to make those risks to come out on top, even if that isn't per se necessary. So the implication of these three mechanisms is that they substantially increase financial risk in the system. Number one, that means that you're more likely to see bubbles emerging on op. In real terms, it means that a bunch of private credit firms may, for example, lend to a particular sector thinking that it will be lucrative, but maybe a specific sector has been exposed to significant amounts of risk, and the set of companies that are within that sector cannot pay those loans back. That's horrible because then many companies need to default on the hefty loans that these private credit firms have given these companies in the first place. So that leads to things like sizable amounts of job loss because, for example, you need to liquidate your assets to be able to pay back your loans. That means you shut down stores to pay back the debt. But it's also bad for private credit investors because yes, they're diversified but as more and more private credit investors get in on private credit, they also get exposed to that risk. So a shock in one specific market, like for example, an emerging tech market or emerging investment in specific emerging markets, means that private credit firms also get screwed when that set of companies cannot pay those significant loans back. And the biggest example of why this is bad is that insurance asset managers are getting in on private credit and using it to diversify. But if insurance asset managers lose such a significant amount of money, that forces insurance companies possibly to push up premiums in response. Brief pieces of weighing. One, weighing against op on growth. When financial shocks happen, they create hysteresis. In other words, permanent unemployment because people lose skills, they become discouraged, they exit the labor market altogether. And on top of that, financial shocks empirically wipe out years of growth because companies do far less investment and slash their R&D budgets. But secondly, it may not be guaranteed that a financial shock happens, but the EV calculation of even a 30% risk of a shock happening is not one we should take. So for example, if you have a button with a 70% chance of giving you a lot of money and a 30% chance of killing you, you don't push that button. Thirdly, this beats any op arguments on growth because even if they prove they get more investment in small companies, we disprove the premise that that investment is good.
The Asian financial crisis happened because a peg failed. The 2008 financial crisis happened because of the subprime mortgage crisis. The 2022 crisis happened because of pandemic. The point of this is to say that crises are A, cyclical and happen when an economy heats up, and number two, because it's triggered by a variety of different sparks. The reason this matters is it's impossible to preemptively regulate financial crises because they happen for any number of structural reasons that can't be perfectly predicted and that central bankers don't have perfect control over. The private credit market is crucial because it makes it much easier to weather these crises that inevitably happen. We agree with Matt's weighing at the bottom about why it's so harmful to a financial recession, but we think that we prevent them actually better. Three arguments on our side. The first is on the availability of credit, the second is on increasing competition overall, and the third is on recession specifically and why we handle them better. First argument then is about the idea of having a much larger amount of credit. So Matt agrees with this, so I'm going to save a whole bunch of time. But I just want to first establish that there's a much larger trade-off than he's saying, because he's saying like, well, we still have like a multi-billion-dollar market. Like, yeah, probably, but like for this debate to have a margin, there needs to be some like big shift. The way I want to do here is to explain why the trade-off in terms of growth is larger than the trade-off in terms of financial stability. And the reason simply is because for financial stability overall, you have private credit, yes, but you also have like the extremely large, like everything else lending market, which often outsizes private credit even in the status quo. Which means that for you to move the needle meaningfully, you need private credit to be really hopping on a train that a lot of other banks and lenders are already on. And I think that oftentimes that means that a bubble is already in motion and it's not really super clear what exactly private credit is doing to worsen the situation. On the other hand, though, the benefits I'm about to establish are extremely micro granular and affect people on a day-to-day basis, helping them make their lives better right now. What are these impacts? Yes, we agree that private credit often goes to small, medium-sized businesses that are just starting out. That is extremely valuable. The first reason for this is because it simply makes monopolies less powerful, because it means that you have a larger variety of options for purchase, like in your immediate area, there's more likely to be fresh innovation. That means that a big company is forced to keep innovating in order to keep its advantage. But number two, it's also the case a lot of these small businesses are just owned by ordinary people who have less money to bank on than traditional businesses, and you put everything they had into an enterprise because they care a lot about it, which is why we think it's important that they have some kind of lifeline at success. The third thing that's really important, though, is that a lot of this money goes to distressed debt, which we agree with Matt is more risky. The thing is, though, we think it's much better that they get some access to debt whatsoever compared to none, which is what you often have when you have traditional banking. Oh, by the way, just quick clarification, the reason why traditional banks are regulated much more than private credit isn't because traditional banks are like smart and like private credit is dumb, but rather because of the extent to which they're exposed to deposits. So we make it harder for traditional banks to borrow and to invest in risky assets because we're worried that they'll use consumers' money as collateral, which is why we stop them from doing this. But private credit doesn't have the same kind of exposure, which is why when they go under, the harms are nowhere near as large. Shareholders miss out, sure. Some maybe hedge fund owners also struggle, but that's okay with us. Okay, just back to the point then. We think it's really important that you have the ability to do things such as re-access credit, especially because the times at which big banks are most likely to pull away from issuing loans is during times of recession and difficulty where the perceived EV calculus of extending a loan to a risk individual is much higher. So for those reasons, we make it possible for them to buy more time, find another opportunity to fill a hole in their business that they've now realized and make money to become profitable again and clear out their debt in the future. We make it possible for people to escape debt and rebuild their lives and earn a shit ton of money, which is really good. Second main argument then is on why this increases competition in the banking industry overall and makes the quality of lending better, not just within private credit, but across all kinds of banks. There are two main mechanisms for this. The first thing is because we think that private credit banks are capable of providing specific forms of lending services that traditional banks can't. Part of this is being flexible because they're less constrained by regulation and because they have a larger amount of their business is concentrated on lending as opposed to is concentrated on investment as opposed to just like taking consumer deposits and investing it in relatively stable assets. And that means that they're more flexible, they're willing to respond to the circumstance, and they're actually better able to make contracts work. But number two, it's also because they often have an investment in making sure that the companies they invest in succeed. And that's why, like PE companies have growth management where they are growth oriented. They will pick companies that they have a fit in. My company was just acquired by a fuck, I forgot that name, like a private equity company that is focused on growing fintechs to a larger size. And I think that that kind of specialization is what makes private credit so popular a lot of the time. But the second main thing is it also creates pressure to traditional banks. And the reason for this is because, like, if, yeah, we agree that the majority of their revenue comes from elsewhere, but if you're now finding it more difficult to make money through loans because a lot of your traditional customers have been going towards private credit instead, you then feel compelled to have a much clearer value proposition in terms of what makes you different and better to them. And that means things such as preferential rates that are more stable. And it also means things such as loyalty benefits that mean that a customer who's stable and banking with them for a long term gains from this. And I think that that pressure also benefits consumers. The final thing, though, is a lot of these private credit companies are smaller, which is why they're better able to do things such as go into blue sky spaces and to do things that invest in the developing world and other places where there is less saturation of investment already. Matt's characterization here is that competition is bad because it means that companies are forced to take bigger and bigger risks until they're basically lending to like terrible businesses that won't be able to make returns on their debt. And that regulation is important because we prevent that race to the bottom from happening. The reason I don't think this is true is because no matter how much competition you have, your instinct is not to do a business practice that is fundamentally not sound. Businesses have internal accounting practices that mean that they can see when a loan that they have made in the past is failing. They see when a company is less credit worthy, they don't just go, well, we have no other choice, so let's invest in them anyway. They instead do things, just find more innovative ways to lend. So, for example, by trading off rates on compromising on known windows, for example, but two, by finding industries where there is less saturation. And that means the developing world, that means things such as emerging industries where we want as much investment and growth as possible. The final thing is on bubbles, where he says that this increases risk because you have a ton of private creditors like flooding to things that might overall inflate the value of different assets. I agree that there is going to be some increase to the extent to which bubbles grow, but when you think back to the most recent bubbles, such as Doge, like such as the dot-com bubble, like most of this was not driven by private credit, but rather by retail investors and big banks as well. Furthermore, I just think that the COVID-19 pandemic was handled super well in terms of like financial crisis mitigation. There was private credit, ahistorical maybe. For those reasons, very happy to oppose.
Hey everyone, so we're moving into the training portion of this session. Uh, Very briefly, in terms of placement, the broad thought here is CA teams usually set motions in prelims, especially in bubble rounds, to ensure that the teams with the strongest raw debating skills break. So now that the teams with the strongest raw debating skills have broken, there is more room to test very specific knowledge or far more technical skills. Out rounds also tend to have higher knowledge expectations. So we thought that private credit was a good place to put this motion. It tests extremely technical skills, especially for back half when you can't just run the standard, PE firms bad arguments. And there are higher knowledge expectations to know things like the fact that, for example, information about private credit loans are not publicly available, or about how private credit loans are given out, the fact that it's usually one or a few big loans. So the broad idea here was just we want to weed out teams that are going to be able to perform well on this type of motion. XK, do you want to talk about strategy on this motion?
Sure. I think this is a really interesting motion because it's very multi-layered and there are lots of different paths to victory. So as you might have heard from our speeches, like there is obviously the growth path, but there's also the financial crisis path. There's also separate things such as investment into desirable industries, so innovation, equity in terms of making credit more accessible. And the important thing to do is to be deliberate about choosing which arguments you're running. So if you're on top half, that means knowing that these arguments will come up later in the round and either trying to cover them to a decent extent by yourself or by explicitly weighing and layering your arguments in a way that makes it difficult for a bottom half team to weigh it as more important. From a back half team's perspective, it's about recognizing that there are these different paths to victory, which makes your job easier because you don't have to find a really specific way to win one of the two big clashes in the debate, but you do need to be flexible and acknowledge where your top half team is doing the worst job and really come in there to prove the biggest impact and then do a lot of explicit weighing against their end impact. I think Matt and I both kind of like try to be strategic and sidestep the meat of the other person's case because it's sometimes just difficult to refute, right? Like it's difficult for us to say that, well, there was no trade-off in terms of growth or financial risk, or to say that like private credit, I could not reasonably say that private credit is less risky than traditional banks. So what we instead did was we did a ton of weighing preemptively within our speeches with things like framing, like starting with my speech with descriptions of various kinds of crisis and claiming that they're difficult to mitigate, for example. So this debate extremely like diverse strategically, and there's a lot of opportunity to be flexible and agile in your case selection.
Awesome. So I'll start out with some CG ideas that you could run. There are four broad ideas that you could look at for CG. The first is that the rapid rise in private credit makes monetary policy harder. So the key point is just, in many cases, central banks will want to do things like cut rates in response to things like demand shocks. When they cut rates, that encourages commercial banks to do things like lend more to businesses. And when more lending happens, businesses are more likely to open up. More people get jobs and spend, meaning that you reduce the effect of the demand shock. But it's harder to coordinate monetary policy with private credit because private credit firms are not as subject to behaviors that the central bank engages in. So it's harder to respond to crises with the rise of private credit because now lots of loans are just tied up privately. Um, The second thing you can say is that this is bad for banks. So you can point out that the rise of private credit also puts pressure on banks to decrease their lending standards. And when money flows out of the banking sector, banks cannot weather shocks to the same extent. They have less capital on hand. And you can also weigh why, even with the rapid rise of private credit, banks still provide more loans to SMEs than private credit does. So the effect on banks is more important than the effect on the companies that get loans from private credit firms. The third thing you can say is sort of a flip of the opening opposition material. Just point out that more lending, particularly in emerging industries, is bad. Monopolization in these industries, in many cases, can be good. These larger firms, for example, can buy out these small and medium enterprises. They have more expertise. They can develop those innovations to a greater extent. They have more economies of scale, which increases stability in these emerging industries. Um, the final thing that you can do, I'm a bit skeptical of this case line, but it is there, and it's a bit mutually exclusive with what I ran in this round. But you can concede that private credit firms will remain strict with lending standards and just explain why this is bad for company operations. So, for example, they might gut traditional operations just to make quick gains. Although I would avoid this because it's veering more into the stock PE firms bad argument, which is not quite the debate that we're getting at.
Okay, so now for the CEO material that I think is viable given the OO that just happened. The first thing is hypothetically, my DLO would have covered the recession material, but hypothetically, DPM could have also been very good, and that could have been undercooked. So just briefly, what that argument is focusing on an environment where there is little access to credit and explaining why A, separating out private credit investment from traditional banking is really valuable to protecting the deposits of customers. So why we don't want traditional banks to be taking on the investment kind of exploratory risky perspective, especially in terms of like preventing recession and reducing systemic shock. And number two, in terms of like, let's say a recession has happened, here's why there are specific private equity companies that are much better equipped to hand out loans at these times, and why they're much more likely to be this catalyst that helps trigger an economic recovery. Second main argument is I touched on the idea of like blue sky investing on developing markets and industries, but I was quite vague as to what exactly those are and why it's so important to have that kind of funding. So running a full extension on that is good. I think partly like you would be, I think it's easy to make the mistake of being like, oh, but like you just end up impacting, and that's not really an extension. You're writing off O's material, but there's also opportunity to be analytically extending on this as well. Like as Matt just said, there's a lot of CG material questioning whether or not it is actually desirable to have private equity like coming in and owning a lot of like emerging markets, for example, and then pushing back on that and explaining how that fits into a growing industry and why the effect is positive is analytical, a clear extension, and also easy to weigh. Third thing is, I think you can also just go harder for the growth argument because I started the argument and explained why it's likely to just be directionally positive, but I didn't size the argument, if that makes sense, in terms of placing the growth in the context of the economy overall to explain how much growth there is and why exactly that leads to better risk management and lower risk of crisis. So I didn't quite reach the impact that the best op version op case is able to do. So going vertical for that and extending analytically is also an option, though it's more difficult to execute because I did spend time on it. So you'd have to be really, really careful and charitable about what OO proved and what you guys are proving. Final thing is the worst case scenario characterization where you bite the bullet of GovBench's most egregious characterization of private equity or private credit. Um, I agree with Matt that the oh they will come in and they're short term so they'll gut you is like stock, but there's also value debating stock sometimes insofar as your judge will be familiar with the argument, and you can save your time for more strategic things to prove. So saying like we okay like let's talk about that particular context and why even like funds that go after distressed debt are really good and how that can provide a last minute lifeline that actually ends up mitigating the total economic crisis, like damage that happens when the company goes under and helps employees.
Okay, great. Thanks, everyone.
Thank you.